This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori, and you're watching The Real Story here on Miles Franklin Media. And gold just surged past $4,940 an ounce. Silver is pressing $97. And we're seeing a pattern. New highs followed by brief pauses, followed by new highs again. We are a few weeks into the new year, and so far gold is up over 13% year to date. Silver is up over 35%. And the very institutions that once dismissed gold as a relic are now racing to rewrite their forecasts. Goldman Sachs just raised its year-end gold target to $5,400 an ounce, citing something crucial. They are saying that they are seeing increasing demand coming from private investors who are staying in the trade. Now, what's interesting here is that this is not the usual short-term move into gold as an election hedge or geopolitical trade. Goldman is saying that these gold positions are different, that they are being driven by long-term concerns about fiscal sustainability, debt, and currency debasement, which means that they are far less likely to unwind anytime soon. In their words, these positions are stickier. So investors, private investors, institutional investors getting into metals and staying in the metals because they have deeper concerns about fiscal sustainability, monetary credibility, and the long-term path of the global system itself. And this suggests that this move is about positioning for what is coming next. And that brings us to Davos. Because at the World Economic Forum, the language has shifted. We were hearing some more open talk of a new monetary order, of fractured alliances, of a world no longer anchored to a single reserve currency. And political leaders seem to be openly acknowledging what some markets have been quietly pricing in for a while now, and that is that the old framework is under strain, the global order is shifting. Now, layer on top of that rising geopolitical tensions, strategic flashpoints like Venezuela and Greenland, and it is clear that we are not just watching a metals rally, we are watching a signal. And joining me now to break it all down is someone that has been flagging this for years, Andy Schectman, CEO of Miles Franklin Precious Metals. Andy, so much to discuss.
Good to see you, Michelle.
Always good to see you. And you know, Andy, every time I talk to you, another record high in gold, another record high in silver. I mean, every time you and I sit down, it feels like that our previous interview has been so outdated price-wise. So let's just quickly focus on the big picture here, Andy. We have gold surging past $4,940 an ounce, silver almost at $97, both which you have called. Now, you've been covering this market for years. We're seeing a pattern, as I said, we have new highs followed by a brief pause, maybe a bit of a pullback, followed again by new highs. So what is your read here, Andy?
I mean, I think, Michelle, all you need to see is the amount of deliveries coming on the COMEX, and I can make it very simple. When I started talking with you about this stuff several years ago, it was about the central banks purchasing gold and the repatriation from the Bank of England and the New York Fed. But now it's progressed to massive deliveries coming on to the COMEX market, entities standing for delivery for billions and billions and billions and billions every single month for going on 16 months. At this level, that's all you really need to see. To me, that's all that is relevant. The people who are standing for delivery for literally in December, as an example, the largest delivery of silver in the history of the COMEX market in the month of December, somewhere in the neighborhood of 68 million ounces of silver. Who's standing for delivery for 68 million ounces of silver? Every month, 3, 4, 5 million ounces of gold or more. This is going on repetitively, and there is no one talking about it. To me, there's nothing else you need to see. So these pullbacks that we see, like we saw this morning, are, to me, not anything other than a gift. Now, it's hard for someone to really, look, short-term caution, sure, anything that's gone up this fast. Long-term bullishness, absolutely, they can coexist together. But I think that when you look at a market like this and see the deliveries, see the rate hikes in margin that do nothing but knock it down for a day or two, shaking the weak hands off, then goes right back up, seeing the lease rates elevated forever, seeing the arbitrage in China at a $8 or $10 difference in price on silver. All of this stuff, to me, would have destroyed the price of gold and silver in years past, like it did in 2011, where they jacked the margin rates up and it never came back. Took 15 years. This market is laughing it off. The people standing for delivery do not care about margin. They don't buy on margin when they're spending billions and billions and billions of dollars. And I just think that is all you need to know. So when we see a pullback, to me, it is not about a whole new bunch of supply that has been dumped onto the market. It is about unwinding of leverage and of speculation and being shook from a position of rising margin responsibility and the selling that incurs as a result of it. But it always used to, when that happened, it would just fall and fall and fall and wouldn't come back. And now all of a sudden, it's like a speed bump and it comes right back. So to me, you don't need to see much else than to see the demand that is coming at the very highest level here in the United States.
So help us understand what standing for delivery means and how these contracts are usually resolved. I mean, people sometimes just pocket the trade in terms of the paper silver. Help us understand what that means to actually now say, no, actually, we want the physical silver with the futures contract, or the physical gold for that matter as well. And how does this compare sort of percentage-wise in terms of how often people actually stand for physical delivery?
Well, most of my career, which is almost 36 years long, no one stood for delivery. Less than 1% of contracts stood for delivery. And that
less than 1%?
Less than 1%. And that is what I've been screaming about for the last several years. And, it started with a group that the COMEX calls the others. Now, they publish a report every week called the Commitment of Traders, which would show the positioning of the largest traders. And it was always just two subcategories: the commercials, JP, Goldman, Citi, the specs, the hedge funds. And one would go long, one would go short. And around 2021, we saw a third group of reportables that was added to this weekly listing of the biggest traders, and they called it the others. And they're still there. We believe them to be sovereign wealth funds in particular. But I started talking about in so many of my videos that something's going on here because big money is now standing for delivery. Now, I don't know the exact percent of it, but I will tell you is that the amount of deliveries that we've seen in the past 15, 16 months here in COMEX, on COMEX, is akin to 4 feet of snow in Death Valley in July. And I guarantee you they're not going to open up snowmobile dealerships if that were to happen in Death Valley. It's an anomaly in every respect of the word. And what does it mean to stand for delivery? That means instead of being cash settled for your contract or rolling it over for another month in the future, they are saying, no, we want the metal right now. And it's delivered into the COMEX ecosystem. A lot of it leaves COMEX, goodbye, and never comes back. Where is it going? We don't know. Is it going to China? Is it going to the Treasury via the Exchange Stabilization Fund? Who's taking it? Is it Tesla? Is it Samsung? Is it Sony? Who's doing it? Now, a lot of it stays in the COMEX, and there are two categories of holdings inside the COMEX. Miles Franklin has 8 Brinks facilities within its storage program. One is in New York City. That is JFK. That is a COMEX facility. I have clients that have a large amount of silver in 1,000-ounce bars in their account, and that's called eligible. Now, eligible means it is eligible to be sold, but it is not for sale, and my clients aren't going to put it into the COMEX anytime soon. Registered, on the other hand, means those bars that are backing the contracts that could stand for delivery. So what isn't leaving the COMEX goes into safekeeping ineligible inside of a Brinks vault or any of the other COMEX facilities where it's not for sale and it's just being held there for safekeeping. Because again, when you think about 68 million ounces, well, if a mint box of Silver Eagles, 500 ounces, weighs 42 pounds, how much do you think 68 million ounces weighs? And who's taking it? Where is it going? How much is leaving? The relevance of it is that it is standing for delivery. The COMEX was never really designed as a delivery mechanism, but in order to maintain credibility, all of these contracts have the ability to deliver instead of cash settling or to use as a hedge. Typically, if we look at these two remote controls here as inventory in my warehouse and a COMEX contract, if I have 3 million ounces of silver in my warehouse right here and the price falls by $10, well, I'm screwed. I'm down $30 million. But if I sold short the exact same amount, they go inverse of each other. The COMEX was designed originally to offset risk, but it's been turned into a delivery mechanism. And the biggest, most well-informed money in the world is doing this. And one of the things that I find to be shocking, Michelle, is the lack of media coverage of this. None, zero. And that's almost, you know, fine line between conspiracy and reality. But where is journalistic integrity? Why is it that we have to talk about this all the time? And no one is saying who's standing for delivery for billions and billions.
Who is standing for delivery? I know I'm asking you to speculate here, but what are some of your theories on this?
I mean, part of me feels like it's the Exchange Stabilization Fund, like it's the U.S. Treasury. I mean, so far in January, which is not a delivery month, I don't know, somewhere around 40 million ounces has already been delivered. I haven't checked it, but I would assume that's about where it is. It was in the upper 20s last week. So even if you take the upper 20s and you add it to the 64, 5, 6 million ounces that was delivered in December, the largest ever, you're at roughly 100 million ounces in the last 45, 50 days that have been delivered. Now, is there any, I think, coincidence maybe that the government classified silver a critical mineral and they just passed a law saying that the government will put price floors underneath critical minerals within the next 90 days? I think that there is this fine line between, you know, could it be Samsung, Sony? Could it be the government not telling us? If it's done under the Exchange Stabilization Fund, they don't need to get congressional approval. They don't need to tell Congress up front because it's for national security. Well, silver has now been made a priority for national security. And so I guess all I'm trying to say is that it's incredibly unusual, and the people at that level who are bringing in that kind of money, who have been following what the central banks have been doing, in my mind, that's all you need to see. And you can see that this is not a mania. It's not a mania because even though we're doing tremendous volume in business, it's not the volume that we saw during Silver Squeeze, where everyone was buying little bits, even a couple $1,000s worth, where the public was starting to expand. Now, these are the people who we've worked with for a long time, or the people who have been watching you for a long time, or me or others, who are finally saying, you know, it's time to actually do something meaningful here. And we're seeing much larger orders. Our average order size right now is exponentially larger than it's ever been. These are people who are concerned, who are aware, and are seeing the same things that we're talking about, but they represent a tiny portion of the public. The public is still vastly unaware of this, and that's due to the fact that how do you explain that we have gold and silver at all-time highs, and it's nowhere to be found on the mainstream media? It's not on 60 Minutes or on the cover of any newspaper.
It's, to be fair, it is starting to make headlines because at some point you cannot ignore these astronomical increases and rallies. It's not really into the how or the why, but you are starting to see headlines on the mainstream because you can't ignore it. You cannot ignore when silver is up almost over 185% year over year. You can't ignore that. Even financial mainstream media. But to your point, the whys and the details get glossed over. I do want to bring up something, Andy, because you said that this trend accelerated, the standing for delivery trend in the COMEX accelerated after President Trump returned to office. Is that a coincidence?
You tell me. Is there such thing as a coincidence at that level? I don't think so. And most of the media attention that you speak to frames it as it's reached its peak, it's topped, it's overbought. A lot of the things that I would argue, if there was really informed journalism, these things that are valid perhaps in a market that is freely traded, but a market like gold and silver, which has never been allowed to find real price discovery. And I think that's undebatable. I mean, that just isn't debatable that metals market have been suppressed for various reasons. We don't need to go down that road again. We've talked about it ad nauseum. But how valid is technical analysis in a market that has never been allowed to find price discovery? In a market where the West has controlled the paper price forever, but that's breaking. And it's breaking because of the standing of delivery, whether it be in London or the abnormal, massively abnormal deliveries we're seeing here on COMEX, to be naked short in a market that is backwardation. Like, for example, let me just say one thing here. I want to read to you one thing. I mean, I think anyone that would be short in a market that is backward, that is in backwardation, is as silly and stupid as a mud wall. TD Bank is one of these morons who, came out and they're one of the ones that are short. And they come out and they say to their public, they say, we enter short spot anticipating a dramatic reversal in prices as silver's devilish blow off, framing it negatively because they're wickedly short. Blow off top comes to completion. And it goes on to say, TD Securities entered a short position in silver futures in early January, betting the price would fall towards $40 an ounce. They placed a stop loss around $92 an ounce to limit losses if the price went the other way. What do you think happened last Friday? At a great expense to TD Bank, they got stopped out. If you play short in a market where you used to be able to do that and drive down the price not only through shorting, but through rhetoric, it would work and it wouldn't come back. Now, they knock it down, great. You got people that are standing for delivery for billions of dollars worth, say, thank you so much, TD Bank. We'll take all of that and watch what happens to the price. And we're going to stand for delivery too. So you need to come up with that silver, not just a papered over payment instead of the real thing. It's an existential threat to these banks, and they proved it in a very, very short period of time, showing just what happens when physical demand overtakes paper manipulation. And that's why I've always felt that the only way you can successfully manipulate a market over a period of time, the way the Western central banks did, is to push it in the direction it's going. And they held it down. No one wanted it. But all of a sudden, there are some very sophisticated people and very wealthy people and very well-informed people, whether it be the central banks or whoever the hell is doing it here, or whoever has been draining the LBMA, and they're like, okay, fine, we'll play that game, and we don't play on margin, so go ahead and short it and watch what happens. And maybe that's why the Economic Times just came out and said, well, you know what? The 5 banks in the U.S., they're actually net long. It's the banks in Europe and the banks in Canada that quite haven't got that memo yet, and this would prove true with TD Bank.
A lot to unpack there, but do you expect, Andy, a moment where this lack of physical metal is exposed in a way that the market can't paper over? I mean, what is the most dramatic outcome that can happen when we talk about this long-standing manipulation, when we talk about how there's so much more paper silver than physical silver? Is there a point where this actually gets exposed, and what would that look like?
Well, it would look like what it looked like to Bear Stearns. And I've talked about this forever, the interview that Bart Chilton did with both Andrew Maguire and Chris Marcus, and then died shortly thereafter. I'm not saying that there is a correlation there, but he came out and said Bear Stearns failed largely because they held the largest short position in silver. This is the head of the CFTC, the Commodity Future Trading Commission, the commodity police, just like the SEC for securities. And he admitted that largely the reason that Bear Stearns failed was because they bet against silver and the price collapsed, and they let them fail. There were reasons behind why they let them fail. They were one of the only banks that didn't play ball with the Fed on something else years before, but evidently that was never forgotten. And so when the price rose dramatically, they collapsed. And this is when you get into the Jamie Dimon thing and all of the stuff that Bart Chilton talked about. It's one of the 2 videos that anyone who owns metal should watch. But the admission from the head of the CFTC that this is indeed what happened, to me, is exactly what will happen. And if you get a failure to deliver where the Fed doesn't come in and backstop, doesn't make Jamie Dimon and JP Morgan take that position, doesn't paper it over, you get a bank like for example, UBS, who realizes that the derivatives that they took over for Credit Suisse, same thing. Do you think they wanted to take them, or were they asked politely to take them? That those derivatives that they hold are worse than they thought. And you get a bank like that who has a failure to deliver, and the U.S. Federal Reserve doesn't come to the rescue, like the last time these things happened in 2008, and the United States had to open swap lines for the Swiss National Bank to bail out everybody. If they don't let that happen, and you see a systemic failure by one of these banks, a failure to deliver. Well, these banks don't just trade in metals, they trade in everything. And you start to get a run on one of these banks, the systemic contagion reaction is like a house of cards that collapses. Could that happen? Yeah, absolutely. And I think that's the mistake that people make, to think that, well, they'll never let that happen. Who's they? And isn't it just possible that when you over leverage a system to the degree that the West has, where you rehypothecate or resell the same piece of metal over and over and over and over again, assuming no one will ever stand for delivery, but everyone does, and you can't get it, what happens? It's the kind of deal whereby they say when you go long, you can only lose what you put up. When you go short, you can lose everything. And it just keeps on going. And I think that is the lesson to be learned, that it could get very, very, very ugly. Now, is it probable to do that? I hope not. But it certainly seems we're getting closer to that point. When David Jensen comes on our show and he says to me, Andy, London has 2 billion ounces in contracts that are outstanding for delivery against a 140 million ounce float, which he would himself tell you, well, I question that 140 million ounce float because they had to borrow money from China recently to make good on deliveries at a far less amount than that. So all of these things are, shrouded in a little bit of uncertainty, and it's a little bit opaque, but you can see it is beginning to break. Mm-hmm. That's the same reason the LBMA perhaps said that their market most of last year was T plus 8 weeks when it's a T plus 1 day settlement. Oh, we have a shortage of manpower and trucks. What you are seeing is a system that is fraying. And it started with the folks in the global south who became, motivated, sophisticated, coordinated, wealthy, and said, let's stand for delivery. Slowly, not too fast to blow it all up. Everyone says, why don't they just take it all? Because the exchange would blow up. Everyone would blow up and they'd cut off their nose to spite their face. But whether it be through an $8 premium over the Western price to slowly arbitrage, whether it be for standing for delivery, whatever it is, they're doing it slowly. You see it happening. And it's starting to accelerate. And TD Bank is a prime example. They put this trade in the beginning of January, and 10 days later, they're stopped out. Now, in years past, bang, the price goes down and it never comes back, in conjunction with rising margins on COMEX, which should knock the wind out of it too. What happened? Price fell. The people on margin had to cover their additional premium that they had to pay. They had to sell. The price fell, and bang, it's right back up again. Because the people that are standing underneath it are not using margin, and they're looking at any subsidy as a gift, as everyone seems to be racing to secure what is now something for national security, perhaps.
Well, we know that it is, to your point, on the critical minerals list, and we know that central banks around the world have been accumulating gold at record levels. I'll zoom out and get to the macro conversation in a minute, but seeing, as you pointed out, the discrepancy between the East and the West, a very important signal that we're seeing in the silver market is how physical silver in Shanghai is trading noticeably higher than in the West. And we're not talking about a few dollars or a few points here. This has been a very significant difference. So what does that mean when we see that this premium has persisted, driven by the strong domestic and investment demand for physical silver in China? What does that tell us?
Normally, when you have a discrepancy like that, Michelle, arbitrage resolves it, right? But it's not resolving it because the Chinese say, thank you. We'll pay more for your metal if you have the ability to buy it here in the West in paper and deliver it in physical in Shanghai. Thank you so much. And it's just that sucking sound that you hear is them really, I guess, trying to tempt and tempt the traders to deliver metal to China for a premium, for a profit. And the fact that it hasn't corrected and it continues to say persistent says that this is their plan. They're doing this purposely. They're doing it to incentivize anyone who wants to make that big profit, where you can buy it. You take 5 million ounces, you buy it here, and you deliver it there at $10 an ounce. Well, you just made $50 million. Easy peasy, and the traders are happy. So are the Chinese with the trade imbalance that they have and shedding the dollars, de-dollarization. They don't care that they're paying a premium. They've been mining gold and silver in their own country For years, that was uneconomical because they see the big picture. And geez, look how economical it is becoming now. No, I think that they see a big picture, and we don't. And so the traders who are doing this are short-sighted. That metal won't come back. It is being reintegrated into the economy, that being gold and silver. It is critical, and we've known that for a long time. And I guess it's just becoming recognized. Everyone talks about the United States making silver critical. They talk about China restricting exports. They don't talk about two other things that are important, and that a year before that, the European Union designated silver critical, and 2 months before China said we're going to limit exports by permitting all of the very large refineries who would have the ability to do this. They said, we're the second largest producer of silver in the world, and our silver domestic production will be kept for domestic priorities. And so you have a race. This isn't about two brothers in 1980 or about leverage and speculation in 2011. This is about silver being repriced, and it's being repriced through physical demand, not through paper that has created an illusion that silver was really not that important. And I've always believed it has more to do with the military-industrial complex than anything. But whatever the reason is, ask yourself this one question. Why would 8 banks in the West control the largest concentrated short position of the roughly 1,000 commodities traded on COMEX of any commodity in the history of the COMEX in silver? 8 banks in the West, in the US and Canada and in Europe. Why? And it was because there was something far more important about silver than its price would be allowed to explain. And it's disappearing in nature, and it's vital in a advanced civilization, whether that be advanced military equipment or AI or technology, digital, electronic, etc. And that's now being exposed through delivery. You can't paper something over when everyone says, fine, but these contracts say we can deliver. Where's my silver? Then we have a very, very, very big problem. And that is, to me, what is happening. And if the Economic Times is right, following Tom Luongo's thesis, which I find to be quite intriguing, the U.S. banks are net long. Who's left holding the bag? The European banks in Canada. Tom believes that Trump is very upset about the European aristocrats. He believes, right or wrong, that they were involved in election interference. Now, Trump just said in Davos yesterday that there was election interference, and there is, and there was, and it's proof, and people are going to get indicted over this. I probably shouldn't have said that, he says. There's breaking news. Well, he believes someone was involved with it. Tom Luongo thinks that he believes it was the European aristocrats that stand behind the big European banks. Well, all this metal that's come back, and if the Economic Times is right, and all the 5 banks have flip-flopped and gone long, including JP Morgan, covering a 200 million ounce short position, then where does this go if we see that moment, a contagion, a systemic failure that blows up not just one bank, but a whole series of banks, while the U.S. banks are net long and out of the mix? So I guess we'll see. I'm not saying that's my total belief, but in listening to Tom and looking at the Economic Times and looking at the Commitment of Traders report, the last one showed that the U.S. banks were net long. I mean, it did show that. They'd still have shorts, but shorts versus longs, the U.S. banks were actually, from a percentage basis, more long than short. So technically net long. We'll see what happens. But I think all I can simply say is, look, this time is different. I've never seen anything like this, ever, never. And normally when margin rates go up, normally when lease rates are that high, bang, the market gets kneecapped and it does not come back. It's taking 24 hours or less and it comes right back.
Well, I want to bring the macro view here, because you mentioned Europe, you mentioned the Europeans and silver, and obviously, as we said, Davos is happening, where President Trump has ruffled many feathers, nothing too unusual for him, but I think this time he's gotten people particularly irked with the targeting of Greenland. So many interesting conversations happening at Davos, but there is one that caught my attention that hasn't gotten too much notice in the mainstream media. And this was messaging from Europe's top political leadership. Ursula von der Leyen, the president of the European Commission, in her speech, subtly just happened to bring up Bretton Woods, the global reserve currency status of the dollar, and the taking the dollar off the gold standard by the Nixon administration. And I found that it was very peculiar that she kind of worked this language into her speech. It didn't even really seem to flow in the general vibe of what she was trying to convey, but it was a very interesting paragraph, and let's play it now.
1971 was the year of the so-called Nixon shock, and the decision to delink the US dollar from gold. In an instant, the foundations of the Bretton Woods system and the entire global economic order set up after the war effectively collapsed. But it also had two major effects. It inadvertently created the conditions for what would become a truly global order, and it provided a sharp lesson for Europe and on the need to strengthen its economic and political power. It was a warning to reduce our dependencies, in this case on a foreign currency. The world may be very different today, without any question, but I believe the lesson is very much the same. That geopolitical shocks can and must serve as an opportunity for Europe. And in my view, the seismic change we are going through today is an opportunity, in fact, a necessity, to build a new form of European independence.
I mean, there you have it. She is explicitly, this is European top leadership, explicitly referencing 1971, the Nixon shock, the moment that the dollar was severed from gold, framing it as a lesson that Europe needs to relearn today, talking about dependency on a foreign currency, about the necessity of building a new form of European independence. I mean, for me, it was a very interesting choice of framing at this point in time, especially as we've been talking about a potential change in the global monetary order. What is your read on this? What do you make?
Well, I think we're moving away from globalism. I really do, and I think gold is continuing to reprice itself on reserve demand and policy uncertainty. I think gold will be reintegrated into the monetary system, and I think, in essence, you know, what she's really hedging at is that a system that is built upon trust, that moral high ground that we stood upon, you know, after World War II, I think has been trampled. People probably don't trust us anymore. And so when there is no gold behind it, yeah, it is a system that is, I think, inherently dying. It is. I mean, any fiat currency is inherently meant to die. And we are getting to that point right now because of a lack of trust. And that's really what it's come down to. In fact, it's interesting because Van Eck came out just the other day, the mutual fund company, and their bond team, it was was built by, or a report written by their emerging markets bond team. I just want to read this to you real quick. You know, I've argued for a while, Michelle, that we are moving to more of a mercantile situation where countries will take care of their own ecosystem. And whether it be looking at Enbridge, which is now operational, as is the unit, and they're trading on it, along with the SIPS, cross interbank payment system, which we talked about how they had signed up the countries from Southeast Asia, the Asian acronym countries that represent 800,000 people, twice the population of the US, 35% of global GDP, China's biggest trading partner by far. They're using these rails now, which chips away from the settlement status of the dollar and using gold to replace the reserve status. I've been screaming this since the first time I met you years ago. And to you in our first interview, I said that, but now there's a report by Van Eck. Now this is very different than James Rickards saying 24,000 or Mike Maloney saying 10,000 as a gold repricing. But here's what they say. They say, what do they say? Sorry, I have it right here. Okay. What if gold replaces the US dollar as the reserve standard? And I would argue that is what is happening. In more so the Treasury, each country using their own CBDC, trading with one another over rails that are not SWIFT compliant or accessible, and using gold as the reserve status, as the reserve vehicle instead of treasuries. They say in this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a 39,000 to 184,000 per ounce price. They talk about M0, which is the base level of money. And if they use M0, just to skip to the good stuff, liabilities divided by gold reserves at M0 is $39,000 per ounce, weighted by daily FX turnover. If central bank liabilities are divided into M2, divided by gold reserves, $184,000. They say using global M2, we calculate the global price of gold that equalizes M2 is around 100,000 per ounce, weighted by daily FX turnover for our sample. The gold price that equals M2 is 184,211 per ounce. What I am saying to you is that I have believed this for a very long time, that gold will be reintegrated as the de facto reserve status, the reserve vehicle, the preferred reserve vehicle of the world. And it's happening in the global south now. And if Judy Shelton is right, and she came on your show and mine and said that she believes, and Trump told her that he will peg the back end of the bond market to gold with the Genius Act working on the front end. If indeed that were the case, right? If you have to sell a $20 million bond in 30 years, deliver $20 million in gold in 30 years at 5,000 an ounce versus 184,000 an ounce by the time you get there, you sell it at 5,000 an ounce, and you're delivering it when it's $184,000 per ounce, you've just massively, exponentially cut the number of ounces you have to give. What else you've done? You've massively devalued the dollar. We're moving away from the dollar being the de facto global reserve currency, I believe. And I think that she is basically saying that once we cut the reserve status to gold, once we cut the tether, the line to gold in 71, that the dollar has been losing value ever since. And it is a system that has lost trust, and our fiscal irresponsibility is such that who in the hell would want to take our dollars anyway? It's ironic she mentions gold. I think that you will see more and more talk of gold replacing the U.S. Treasury as a de facto reserve settlement vehicle. And whether it be in treasuries here or to settle currency and trade imbalances in the new multi-jurisdictional Shanghai Metals Exchange platform connected to the digital yuan, which will be the rails to the mBridge unit tokenized currency, which is actually now working and running and has passed beta tests. So these things are happening, whether the West wants to agree with it or not. I think she's probably being a little bit more honest, kind of veiled honesty, but more honest than I think you'll hear from a politician on this side of the pond.
Well, that's sort of the MO of the World Economic Forum. They surreptitiously telegraph what is going to happen. In previous instances, like with the global pandemics, they put out the messaging, not directly, but very subtly, so that people sort of start to adjust and brace for it. And, to your point, Andy, this has been a shift that you have noted for a very long time now, as we have seen exacerbated with the record purchases of gold by central banks. I mean, Goldman has it down that they expect central banks averaging 60 tons of gold per month in their latest report. They expect emerging market central banks to keep structurally diversifying reserves into gold, with purchases averaging about 60 tons per month in 2026. So that is clearly a trend that we're going to see, continue. But I've always maintained that I don't see the United States just lying down and taking this, right? I've always maintained that there will be some pushback. I know you have your theory that that's perhaps where this covert purchasing of gold may be happening, this shadow program to be buying gold. And that, again, links back to your idea of physical delivery that we've seen accelerate since the Trump administration took office. But when you put things into context of the United States and the Trump administration starting to reflex its military muscle around the world, starting to consolidate power around the Western Hemisphere with this move into Venezuela, with this desire, very strong desire to have some kind of sovereignty over Greenland. I mean, what does that signal to you as a potential next step here?
That they are pulling away from globalism. You have Howard Lutnick, who just came in to Davos, and he said the same thing. Globalism has failed, and that he came out and publicly said this, and I think that's kind of the theory here, is that we have to worry about ourselves first rather than everybody else. We have to protect ourselves, and we have to bring back manufacturing, or our kids and our grandchildren have no future. We're 200 trillion in debt. We're uneducated. Ray Dalio just came out and said 60% of America has a literacy rate under that of the 6th grade. Here comes AI just to take all the jobs just in time, and we don't make anything. The only way to make things or to sell your goods to the world is to abandon the reserve status. I believe that's what they're trying to do. They don't want to be the reserve status. They want everyone to trade their own currencies. The only way to get credibility and to have people buy our bonds, because if not, we're dead, right? Who's going to pay for all of this? Or we're going to monetize it and create hyperinflation within our own borders, is to have the gold backing. You look at the Genius Act, which basically says that the interest that is created on the treasuries that back the stablecoins, and this goes into effect January, like right around January 1st of next year at the latest, is not transferable. So what has Tether been doing with the interest that they're accumulating on these stablecoins and the treasuries that are up to 90-day treasuries that are one-to-one linked to the stablecoin? They're buying gold with it. They have 14 billion in gold already, the single largest stockpile in the world next to central banks. What does that do? That devalues the dollar. And that's what they want to do, to sell products to the world. And if they peg it to the back end of the bond market and use anytime money moves after this is implemented, anytime, it creates synthetic demand for the front end of the curve. Up to 90 days will back the movement of money. The stable coin rides on the rails of the blockchain and is backed one-to-one with short-term 90-day or less treasuries, which the interest is not transferable to the holder of the stable coin. When I send you money, a stable coin is created. It's backed by a treasury. When you get it, stable coin is burned. That treasury interest, that stays with the issuer. So that issuer then has to do something with it. They've been buying gold, which is my theory, which is why you will see gold go higher, the dollar go lower, in an effort to bring back manufacturing and sell it to the world. But how do you bring it back? Well, you create zero coupon bonds back to gold. And as the price goes higher and higher and higher over the duration of the bond, and when you finally have to deliver the gold at maturity, gold is way higher than when you sold it, and it's just a fraction of the ounces. This gives you a chance maybe to grow yourself out of this problem down the road. Otherwise, what do? You inflate or you default like every other government has done before us. I think what President Trump is doing is to have the courage to make the realization that the can has been kicked far enough and we can't keep doing it, or our kids and our grandkids have no future. And that's just the truth.
Well, we have been seeing this de-dollarization trend accelerating for a while now. Central banks now owning more gold than U.S. treasuries. We actually had a few more Nordic pension funds and institutions now de-dollarizing as some kind of pushback to the Trump administration, although they are arguing that it has nothing to do with the Trump's move on Greenland. They're saying that they're divesting from their treasury positions because they want to rethink liquidity and risk management, and that this isn't political, but it's an acknowledgement of rising tensions in Europe. That didn't make the decision harder, but they're trying to say that this is about the US's fiscal position, which, as you and I have discussed, is in an unsustainable level of debt reaching well over 38 trillion now. So we did have the Denmark, the Akademiker pension fund announcing that it's divesting all of its U.S. treasuries. In Sweden, one of the country's largest pension funds, Electa, has cut the majority of its U.S. treasury holdings, selling nearly $9 billion worth of U.S. treasuries. So
let's not forget about Japan, too. You know, they're selling treasuries because they have to bring that money back. And that was the piggy bank to the world for the last 20 years.
But what's interesting, and I want to play the soundbite from the president and link it back to what you've said, that perhaps the United States has been preparing for this under the Trump administration. he who has the gold makes the rules, the golden rule of negotiation. And I think the president may have kind of alluded to that when he was asked about this de-dollarization trend. I think we can play that clip now.
So what should we expect from the European countries? I mean, they've got this EU anti-coercion instrument that would be, services, impacting our services, as you said. And then the Danish pension fund said that they're going to exit U.S. treasuries, $100 million treasuries at the end of December. European countries hold trillions of stocks and bonds from the U.S. Do you worry that they would start selling those in retaliation?
If they do, they do. But, if that would happen, there would be a big retaliation on our part. And we have all the cards.
We have all the cards. What do you make of that, Andy?
Yeah, I mean, I think you're right. He who has the gold makes the rules. And I think he is preparing for that. And I think there is nobility in what he is doing. I do. Honestly, I do. Everything he's talking about has gold in it, even the Golden Dome. It was called the Iron Dome, I thought. Now it's the Golden Dome. He keeps making these comments about it. And I think there is a realization that gold is going to be rewired or reworked into the system. I think he understands that. I honestly believe that he got together with now again, I could be naive. Maybe I'm wrong, but it just seems too coincidental that, when he comes into office, before he even takes office, when he wins the election, all this gold starts coming back. And I think they got together with the banks and said, you idiots are so far short, it is an existential threat, and the rest of the world is buying it. So here's what we're going to do. We're going to tell everyone this is about tariffs, and your collusion that you've been doing for the last 30 years, you and the European banks and the banks in Canada, to maintain dollar supremacy, bond market supremacy, and to keep silver cheap for the military. Well, we're going to say that has to, you got to just send the bars back. Don't worry, it's a one-way tariff. This will end. You got to send it back. We got to cover, and we're going to reshore it. And it is not going to go back. And they've been bringing all this gold and silver back to the tune of billions and billions and billions and billions and billions of dollars worth every month, because he sees what's happening. And they understand that the global south is already ahead of us in reintegrating gold into the system. And we have to do it as well. And I think the same thing is true about silver. And that is why you saw all of these imports.
Right.
And ironically, they classify it critical.
Well, you mentioned Ray Dalio earlier, the founder of Bridgewater, and he's been very explicit about what he believes is happening beneath the surface with regards to the monetary order breaking down, echoing a lot of your theories and ideas. And to me, it's interesting that, again, this conversation is now being trickled into the mainstream, the idea that we are on the verge of a potential change in the global monetary order. And this is one of the conversations happening on the sidelines of Davos. Let's take a listen to that.
The monetary order is breaking down. Okay. What I mean by the monetary order is that fiat currencies and debt as a storehold of wealth is not being held by central banks in the same way, and that there was a change. The biggest market to move last year was the gold market, far better than the tech markets, right, and so on. And the U.S. markets underperformed foreign markets because of the fact you could see it in the numbers of the central banks and so on. So let's just look at the fact that on the other side of trade deficits and trade wars, there are capital and capital wars. Let's just take a moment on that capital war issue, okay? We know that both the holders of U.S. dollar denominated debt, which is money, and those who need it, the United States, are worried about each other, right? So if you have other countries who are holding it and they're worried about each other and we're producing a lot of it, that's a big issue, right? So you have to explain what is going on with fiat currencies, generally speaking. And now if you take the conflicts, you can't ignore the possibility that capital wars, in other words, maybe there's not the same inclination to buy U.S. debt and so on. We at least need to talk about those possibilities and find out who is buying and selling what that is behind these market movements.
I mean, he's basically saying what you're saying, not mincing his words there either. Does the fact that this is out there now signal to you that this shift perhaps is even further along than we think?
Yeah, but it's out there, but it's not out there, right? I mean, it's out there. How many people watch that? You know, how many people watch us? You know,
Only the smart ones.
well, you're right, but go and try, you know, and talk to 10 of your oldest friends about gold and silver for 30 seconds. And yeah, they may say, yeah, I see it's been going up, but that's it. You see nothing, you hear nothing. When Reuters talks about silver's run, just like TD Bank, they call it the devil's metal. And I mean, everything is in a negative light. It's overbought, it's peaked. It's just like 2011. It's just like 1980. I mean, and I think it's just completely been ignored. Now, you know, as he points out, the S&P not only did it underperform European, it wickedly underperformed gold and silver. And this in the face of what, a 19% gain or so, 16, 17, 18, 19% gain in the S&P in the face of the greatest tech boom ever with AI, NVIDIA and whatnot. And gold is up 70% and silver 150%, and not a flippin' word by the mainstream. And even more importantly, if they would have followed that trail, they would have led them to the COMEX. Who the hell's doing this? Who's doing it every month? Who's standing for delivery? Who's spending billions and billions and billions of dollars? Where is the journalistic integrity? Ray Dalio, I give him credit. He's a mainstream guy who has the courage to say what he feels, even though he may not really be saying it like he wants to, but he gets it. And he's been talking about gold for a long time.
But Andy, on that note, you talk about the journalistic integrity. Can you actually obtain the records of who is standing for delivery? I mean, I know there's
no, but
rules.
You can see the delivery records. You can see the amount of gold and silver coming into the COMEX, which is as unusual as.
But how opaque? How opaque is the actual COMEX in terms of, is there an ability to actually follow some kind of paper trail? Like, we know that there's certain SEC regulations with insider sales filings that eventually these things have to come out, that there is some level of transparency. With regards to the transparency of the COMEX, I mean, someone knows where these things are going, surely.
Well, and the fact that no one's talking about it, but a guy like me trying to figure it out, I mean, that's the point. You know, it doesn't matter who's buying it. The fact that someone is, or someone's are, is all that matters. And when you see at that level, I would argue, when you're spending hundreds of billions of dollars, and it never really has happened before ever to this degree. I mean, sure, we've been net exporters of gold for most of my career, 36 years. Now we're maybe the largest importer. And you just see massive imports coming in. The question should be asked, who's doing this? Why all of a sudden? It's really very unusual. And that to me is the most important part, because at that level of money and wealth, they know the playbook. Their information is worth more than the money they use to buy the stuff with, which is worth more. The stuff they buy is worth more than the money used to buy it. So, you know, information is at the top, and what they're buying using the money that they're using to buy it, or the currency, I would argue is very smart. And to Ray's point about, or to your point also about, you know, all these companies or countries or pension funds or whatever moving away from dollar. Why would anyone want to hold a dollar? You know, the measuring stick by which we measure the dollar, the Dixie, the dollar index, is flawed, because all of these countries are constantly devaluing their currency against ours. That's just the way it works. And whether it be to sell exports, or because you have to go into the open market at some point to buy more dollars to transact global business, unless you hold a huge stock of them or stash of them, reserve of them, that means you're holding our treasuries too. Both are a sucker's game. So you look at a dollar index that says the dollar was down 9% this year. Okay, how about against silver, 150, gold, 70 or 80? Point of it is that why would anyone want to hold our dollars? They have the lasting power of a melting ice cube. And why would anyone want to hold our treasuries? Not only have they performed horribly, half the performance of the 10-year treasury for 25 years. Look at the last 2 years. Gold up 40% in 2024. 2024, the 10-year treasury up 4.5%, 5%. Okay. How about last year? 10-year treasury up 4%, gold up 70 or 80%. Keep on going. But it has no counterparty risk. So these things are very, very obvious if you look close enough, and Ray's saying it. And that's what the pensions are saying. No, it's not about Trump. I believe it's not about his policy. It's about the fact that we have ridiculous fiscal irresponsibility and that we are selling and so much debt. We're going into $1 trillion of debt still at the clip of 100 days per trillion. And, that's not sustainable at some point. Now, people point to Japan and say, well, they're 300% debt to GDP. Yeah, but they have the largest savings in the world. They have a net surplus in trade. Everyone buys from them. And the Bank of Japan owns most of it, but they're not the reserve currency. We are. And that's going to have a problem. Now, you pull all this money out from the yen carry trade, the reverse yen carry trade will be just as disastrous as it was bullish. Now, it hasn't crippled it yet, but the Japanese bond market is breaking and rates are going higher, which that means you will see more capital, including that, rumor has it, of Warren Buffett, who has been sitting on the sidelines with $400 billion in cash, is now deploying money in Japan, so I hear, because he sees opportunity there. So I guess my point is that recency bias, normalcy bias, all of these things that the mainstream points to and the media neglects, to me, are very clear and easy. Who's doing it? That's unusual to the nth degree, and that's all you need to know, because at that level, information is key, and they know it. They know where it's going, and it's followed the central bank path for the last 5 years. You can see it. Central banks led the way because they write the book. The folks here in the U.S., well, they're part of that book too.
And it looks as though they're continuing to be writing the same chapters in that book as this trend only continues and accelerates. And, for me, the whole point of the Davos World Economic Forum acknowledgement on some level that this global monetary order is shifting, is cracking, something that, as I said, you have discussed for a long time now, but we're seeing it play out. And that is why I think we're seeing the Trump administration encircle its perimeter, consolidate power, as you've discussed, be more sovereign, onshore manufacturing, start to bolster forces from a military perspective, start to consolidate, as per the Monroe Doctrine, presence in the Western Hemisphere, because this multipolar fracturing is arguably inevitable. So, and not because of the Trump administration, this has been going on obviously for years, but in preparation for that, trying and consolidate accordingly. And I think the fact that, as I said, this is becoming a topic, granted, not as out there as you would like, or that you would think should be merited, but it is starting to seep into the conversation, only further consolidates that idea. So, Andy, as we wrap up here, I mean, obviously we can discuss the details and so many theories and strings to pull on this, but as we wrap up for this particular conversation, we've got silver pushing 100 nearly. I mean, I think you said you expect silver at 100 by the end of January, and I know you don't typically like to give price forecasts, but that is where we're heading. And a gold almost not that far off from 5,000. Some people are saying, should we be selling? Should we be swapping silver into gold? What is your perspective on how you're playing the metals positions right now?
Well, we're getting close to that moment where you can start thinking about swapping your silver to gold. We're at about a 50-to-1 ratio. I started telling people about that when it was 100-to-1 in March of 2020, and it's stayed. I guess it stayed irrational longer than a lot of people really like, but it's starting to move back to where it should be. And I think if you bought in 2020, you could start by maybe like layers of an onion, peeling some off and trading some silver to gold right now. But again, the argument against it is that it's an asset that is finally maybe going to find global price discovery after never being allowed to do so. And how low does it go? I guess we shall see. I don't know exactly how low the ratio goes, but I would start looking at it very seriously right now with some. And as we get into the 40s and below, then yeah, you continue to do it. Granted, it's coming out of the ground at 7-to-1, and it is now seemingly trying to find real price discovery. As far as the price goes, we talked about it, and I said months ago, like, if you take technical analysis, again, in a rigged market, how valid is it? in terms of where it stops. But I did say publicly that I think 96 is easy, because you take the top of the cup in 1980, the bottom of the cup in the early 90s, that's $4. The difference is 46. When it finally makes the top of the cup and then the handle back above 50, you add that to the top, that's 96. This is where the breakout, anyone using technical analysis would say we are. This is why you're getting all the, well, it's, technically you might want to sell it, but I don't think so, because now it's national security. Now the government's buying it. Now there's a floor underneath it. Now it's being drained from the exchanges. Now we are beginning to see, through delivery by very sophisticated people all around the world, not just in North America, but in India and in China and so in Saudi Arabia and Russia, they're all saying, this is what we're going to do. We're just going to gobble it all up. It's a race to get it. Where does it stop? I think a lot higher than people think. Michael Oliver, who uses momentum analysis, says 200-300. Wouldn't surprise me. I mean, I guess it wouldn't. I guess we'll see. I don't buy it to become wealthy. I buy it because it is wealth. You're beginning to see that play out again and finally accentuate itself after being held down for literally decades by the West. Now all of a sudden it's trying to find what its real price, and I think it'll go much higher. If you told me it would hit $200 this year, I wouldn't be surprised. I'm not saying that's where it's going, but it wouldn't shock me at all. And look, if you take gold right now, which is at let me see, roughly 49.40, and divide it by 7, which is the geologic ratio, its real ratio. I'm not saying it's going to get there, but 49.40 divided by 7 is $705 an ounce. All right, so 705 versus where we are. If you take it right now at 96, somewhere in between, could it be? Yeah, why not? If that's what it's coming out of the ground at, if we are on our 6th year of structural deficit between supply and demand, if it's now critical, if China's going to restrict exports as the world's largest refiner of doré, as the European Union makes it critical, as there is a realization that it is critical, and don't forget about the monetary side. How high could it go? Well, I guess you could say somewhere between here and 700. Wouldn't surprise me. You get that high, sure. That's overly optimistic. But if you said $200, is that really that crazy? I don't think
$200 by when?
By the end of the year. Who would have thought we'd get to 100 as fast as we have? I mean, we're just an eyelash away. Now, I will say this. If I were the banks that were trapped, I would try to knock it down at about 98 or 99. I would, because that's how everyone waiting for 100, that big round number. And then everyone that falls out, you scoop it up and it shoots right back through it again. But 150, within the next month or two, at the rate we're going, sure, why not? I'm not the kind of person that makes these guesses or projections. Just looking at what we've seen so far, in May it was $30-some.
Right.
And now we're $90-some. So again, it's just being set free from being caged for so long.
Right. And similar movement in gold. The Ray Dalio clip, gold was at, they had a ticker up there, gold was at around 4,700, and that was only from a few days ago. So it's just, we can't keep up with the way these metals are moving, which is why we had you on this evening. But I know we're out of time, and hopefully by the time we speak again, I suspect that these prices would have already been well exceeded. I mean, hopefully on the one hand, but not so hopefully on the other hand, because as we've discussed, it means that there's a major structural issue happening.
Well, let's just agree that there is a major structural shift happening. I believe there is, and this is a manifestation of it. And the thing of it is that the people don't know that there's a structural shift happening. They're too focused on technical analysis. They're too focused on what has always been. This isn't the same country that has always been. This isn't the same amount of debt that we've always had. This isn't the same level of lack of trust that we've always had. These are things that are changing, and everything changes. Everything changes, including reserve currencies, and everything has to change. And if you don't realize that, then I think if you don't roll with the changes, can't see them, you don't roll with them, you get rolled by them. And I think the big money sees that, and that's why they're doing what they're doing. The little people, unfortunately, left holding the bag, the people who are loaded into equities and loaded into mutual funds, and they just blissfully whistle, down the street. They're the ones that get rolled by this when it all happens. I hope I'm wrong, but I don't think I am.
Well, so far, You have been very, very, very right in every way that this has played out. And the only thing that is constant is change. So it stands to reason that this will continue to develop the way you're predicting that it will. Andy, let's leave it here for tonight. Thank you, as always. Always love chatting with you.
Always great to see you too, and hopefully see you back in the studio real soon.
Yes, I will be back in Florida very soon. Thank you so much, Andy. And of course, a big thank you to you for watching. Make sure to hit the subscribe button if you haven't already. Set your notification alerts. And by the way, we also have a weekly newsletter that you don't want to miss. It has previews and specials. There's a link in the description. It's also on our website, milesfranklin.com. As always, leave us your comments. Feel free to praise, whine, or just opine. We love hearing from you. We'll see you next time. Until then, stay sovereign.
This is The Real Story with Michelle Makori.